Step 3 involves crafting your offer. Once you've completed the exploratory due diligence process and determined that this is what you want, it's time to make an offer. First, you'll want to assemble your team of advisors. At a minimum, this should include an attorney with experience with business transactions. You'll also want to have a CPA who is willing to teach you about the finances of your business, like the profit and loss statement and balance sheet. You'll also want to make sure you have a lender from a major bank or a credit union. And finally, it's a good idea to have a mentor or a trusted advisor who can provide you with business advice and support. It's never too early to start considering how you're going to pay for the practice and engage lenders in your area. In many cases, regardless of a practice appraisal or a negotiated purchase price, the practice often will sell for what a lender is willing to lend a borrower. Most banks will make a lending decision based on the global cash flow of the borrower. We've already discussed that the true value of a practice is essentially what a buyer is willing to pay. However, before you put in an offer, ask for a copy of the practice appraisal if one was performed. Many sellers hire an appraiser who can summarize the tangible and intangible assets and apply common valuation methods. When it comes to practice valuation, in my opinion, the most reliable way to determine a value of a practice is by measuring what the practice will support after your mortgage, bills, and taxes are paid. I find this is the least subjective method of valuation and one preferred by lenders. It's important to keep in mind that lenders only lend about 80% of available cash flow and have an arbitrary lending limit of 60 to 80% of practice revenue. So if a practice sells for higher than this limit, it will be imperative to come up with another method of financing. Now, once you've established a fair market value for your practice, how you take ownership is an extremely important decision. Generally, you can choose an asset purchase or an entity or stock sale. Buyers generally prefer asset purchases as liability doesn't transfer, while sellers prefer stock sales since it lowers their tax burden. At its simplest, an asset purchase means you're purchasing the tangible and intangible assets from a seller, but not the actual company, which means you avoid any risk of liability from the previous owner's business. In an asset purchase, the IRS requires the buyer and seller to classify all assets as tangible and intangible. You'll want to lean on your CPA for this, but basically tangible assets are taxed to the seller as ordinary income, while intangible assets are taxed at the current capital gains rate. Therefore, the seller may prefer a higher purchase allocated to intangible assets than tangible, as ordinary tax rates are typically higher at the time of the sale. A stock sale means you purchase the actual company's stock. As a buyer, you can't depreciate the assets with a stock sale, so you lose a tax advantage. This is where you'll want to leverage your CPA and potentially reduce the purchase price to account for this loss in tax benefit. However, you also avoid re-credentialing all of your medical and vision plans, as the federal tax ID will be transferred to you. You'll definitely want to make the most of your attorney and tax advisor on this topic, as there may be circumstances that influence your decision on how to take ownership, as well as how to allocate the purchase price. The IRS will require the buyer and seller to agree on the allocation of purchase price, since there are different tax implications for each party. Now it's time to work on your letter of intent. The letter of intent contains the price that the buyer will pay, as well as any contingencies built in. It should also include all terms and conditions of the sale, financing, lease, type of sale, and anticipated closing date. Finally, one additional consideration will be how you and the seller agree to manage the accounts receivable after closing. This represents the revenue generated but not yet collected from both patients and insurance companies prior to the day of closing. Generally, the seller retains ownership of the accounts receivables. You and the seller will want to discuss an efficient and practical method for tracking these receivables after the closing. For more information, reach out to the team at VisionSource. Practice management transitions can feel daunting, but we have a team of experts who can walk you through each step that leads to your goal. For more information about how you can achieve your goal with less stress and expert guidance, fill out the form below and we'll be in touch.